Toronto just recorded 0 new condo launches for the first time in 35 years, and the private credit markets that funded the last decade of that building boom are now telling investors they can't get their money back. Welcome to the Daily Brief Canadian Macro. I'm Steve. Today we're covering Canada's housing market collapse, the cracking private credit bubble, and why equity markets are hitting all-time highs during what's being called the biggest energy crisis in history. We heard from Market Mania on Alberta separation and BC property rights, Mark Mitchell with the take on media bias, the Loonie Hour breaking down the market paradox during the global energy disruption, and IceCap Asset Management warning about private credit defaults. Let's start with the political and legal instability that's making real estate even harder to value. Market Mania covered what they're calling an existential crisis for Canada through two major developments. Their core argument is that both Alberta's potential separation and British Columbia's property rights collapse are symptoms of Canada's broader descent into authoritarianism. They point to a federal agreement signed February 20th that granted the Musqueam tribe Aboriginal title over Greater Vancouver, including Vancouver, Burnaby, New Westminster, and several other municipalities, all done without public consultation. What's interesting here is Market Mania's claim that Aboriginal title means full ownership of the land, giving these groups the right to charge rent to current property owners or even evict them. Now, legal scholars dispute exactly what this means for existing titles, but the uncertainty itself is the market risk. A cloud over BC property titles is enough to spook institutional buyers, regardless of how the courts eventually rule. On Alberta, polling on independence typically lands in the 20 to 30% range, though separatist advocates and many Albertans argue those figures undercount silent support. What's harder to dispute is the trend. Whether the real figure is closer to 30% or 50%, the political risk is real enough to price into any long-term Alberta asset. Market Mania notes that the Supreme Court's 1998 Quebec secession reference established that any Canadian province can legally leave with a majority vote on a clear question. This connects to broader concerns about market stability and investment risk. Mark Mitchell took a satirical approach to examining media bias in financial and political reporting. His main point is that traditional journalism often fails because reporters can't ask tough questions when sources pay their salary, creating inherent conflicts of interest. He demonstrates how sources will shift explanations when challenged, first blaming war for problems, then weather, then abstract concepts like pent-up demand, all without providing evidence. Mitchell argues that real journalism requires recognizing when you're interviewing someone with clear financial incentives and seeking out independent experts instead. The reason this matters for Canadians is that it highlights how the power dynamic between media organizations and their funding sources creates pressure to avoid challenging questions that might upset revenue streams. This framework applies whether you're talking about housing policy, energy regulation, or Bank of Canada communications, and it's worth keeping in mind when scrutinizing data from any single source, including on questions like Alberta separatist sentiment. The three amigos at the Loonie Hour dug into what they call the market paradox, equity markets hitting all-time highs during what the IEA calls the biggest energy security threat in history. The Loonie Hour's thesis is that this reflects a debasement trade, where investors choose corporate management over government decision-making to protect against inflation and fiscal irresponsibility. The housing data they presented is particularly striking. Toronto had 0 new condo launches in Q1 2026, the first time in 35 years, with 92 months of standing inventory. For context, a balanced market sits at 2 to 4 months. 92 months means developers can't launch new projects without cannibalizing their own existing inventory. The Loonie Hour calls it a complete market disaster, and the numbers back that up. They also note that Canadian youth unemployment has reached a multi-decade high. The headline measure sits around 13.6%, but the Loonie Hour argues the true rate is closer to 17.8% once you account for workers who stopped looking, people who've left the labour force entirely and are no longer counted as unemployed. On the energy front, Canada's CPI rose to 2.4%, with energy surging 13.1% month over month, while the Bank of Canada's 3 core inflation measures have stopped falling. The Loonie Hour's call is that WTI oil's new baseline is likely $80 to $85, up from the previous 55 to 58 range due to permanent energy security concerns. That's their view, and it sits meaningfully above where the futures curve is currently pricing things. This energy theme connects to some serious warnings about credit markets. IceCap Asset Management focused on cracks appearing in private credit markets. To put the scale in perspective, Preqin puts global private credit assets under management at roughly $1.7 trillion. IceCap's figure is closer to $2 trillion, but either way, these markets grew from around $100 billion in just 15 years to their current levels. And that growth was built almost entirely on cheap money assumptions that just no longer exist. Historically, private credit defaults run 2 to 2.5%. Morgan Stanley is warning that could surge up to 8%, more than triple the norm, with software lending most exposed as AI hammers valuations. What's particularly concerning is that floating rate loans that seem healthy at 2% rates are now struggling at 5%, causing covenant breaches and defaults as companies face dramatically higher interest burdens. And yet money kept flowing in right up until just recently. Nearly 25% of multifamily offices increased private credit allocations recently, but many don't understand what they own or that liquidity can evaporate entirely in stress scenarios. IceCap notes that funds are now enforcing redemption limits as investors rush to exit. People are trying to get their money back, and funds are saying no. Well, looking across today's analysis, we're seeing multiple creators point to the same underlying theme. Traditional structures and assumptions are breaking down. Market Mania argues that property rights in BC are becoming unreliable due to secret government agreements, while the Loonie Hour shows Toronto's condo market has essentially frozen with zero new launches. IceCap warns that private credit markets built on cheap money assumptions are cracking under 5% rates, while the Loonie Hour explains that investors are fleeing to equities in a debasement trade because they trust corporate boards more than government decision-making. Both Market Mania and the Loonie Hour point to inflation resurging, whether through energy costs or broader fiscal irresponsibility. What's interesting is that the Loonie Hour suggests this market strength may actually embolden political leaders to take more hawkish positions, while IceCap argues that many investors don't even realize they're exposed to these private credit risks through their balanced funds and structured products. The question isn't whether some of these structures crack, it's whether Canadian households are positioned to absorb the aftershock. Well, that's our daily read for today. All credit goes to the creators featured. Their original analysis and videos are linked in the description below. If you found this video helpful, please subscribe, hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve, as always. Nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.